Hi, I'm Stephen Carson, coming at you from St. Louis, Missouri, in these United States. Um, Before I bring Ryan on, I'll just say that we have a great coincidence between people who watch the show and people who subscribe. We have good engagement, is what I'm trying to tell you. Our subscribers watch the show, they seem to like it. Our watchers subscribe. In terms of growing the show, which we'd like to do, the way you can help is to share with friends. You know, if you're on Twitter, retweet my tweet advertising the episode. If you're in other corners of the internet I don't know about, bring it in there. Bring the links in there for the YouTube, and then like the video on YouTube. That would be very helpful. By the way, I don't mention it much, but last I checked, I just set it on auto and it just does it. Last I checked, these videos are available on Odyssey. They don't live stream, but they are available afterwards to watch on Odyssey if you want to use alt tech, which is probably a good idea. And then finally, I'll just mention that we get our support from very small, humble monthly donations from a number of people on Subscribestar. So it's a fabulous way to support the show. I am looking to those donations to buy the lights I need, so I stop having fuzzy things behind me and all this sort of stuff, and the shot starts looking that much better on the production values. We're almost there. So your support's appreciated. All right, let's go for it. This week is Econ Minis with Ryan Turnipseed. Hello, sir.
Hello, how are you?
Pretty good. Now, you actually are not wearing the same tie. So, since you're a college student, a beginning college student, you probably have more ties than like anyone you know at school, right?
Yeah, probably. I've been changing ties for like every stream that I've been on and like
Oh, okay.
here and AA stream, like they change every time.
Oh, okay. Good. Very good. Wow. Yeah, I need to, since I do bow ties for this show, I need to buy more bow ties. That's what I should tell my wife to get me for Christmas, more bow ties for the show. um,
That's a wonderful gift.
yeah, yeah. Okay, so let's see. Right, so this week is Econ Minis. We're just doing a little bit of an update on economic issues, mostly domestic. We had been following China, and I, for whatever reason, just didn't have any China stories this time. We had covered recently Evergrande or Evergrande, however you say it, collapsing, or that it was about to collapse. Since then, it has. They've gone into what is it? They're not going to pay on their debts.
They defaulted, didn't they?
They defaulted. Yeah, sorry. Thanks. That's the word I was looking for. Yeah, Evergrande defaulted. It hasn't brought the world down around our ears, but it is an interesting development, which we had been tracking for a while. So we tell you about stuff before it hits the news, right? Okay,
That's the
so
plan.
let's go to our first article. Now here we're going to get a little bit wonky. Strap in, because Ryan pointed out that when we talked about what tax was it, Ryan?
We were talking about the sales tax on one of our previous videos, and we discussed some of Rothbard's writings on it, and we got a lot of pushback saying that Rothbard was wrong. Taxes do get passed on.
Passed on, right. So the idea is that you put a sales tax on all the retailers selling candy bars or whatever, and the consumer just has to pay that much more. So it's that tax is passed on to the consumer, right?
Right.
And we'll see why in this treatment why people think that. Probably the main reason why people think that is coming up. But go ahead.
And I I remember the incident. This was in relation to the White House press secretary making the claim that the tax doesn't get passed on, and a lot of the normicons kind of jumped on that and said, "Oh, well, that's against basic economics." And we said, "Well, in a sense, no."
That's right. Exactly. Sometimes in the urge to score partisan political points, people don't stick with the truth, which is sad, and we try not to do that around here. So, so Ryan suggested that we turn to the man himself, Rothbard, and look at the section in Man, Economy, and State. Real quick, if you don't know, the Austrian school had two major treatises that everybody looks to: Human Action by Ludwig von Mises and Man, Economy, and State by Murray Rothbard. You'll sometimes see it now published as Man, Economy, and State with Power and Market, because they left off the more radical bit when they originally published it. But anyway, now it's all back together. Make sure if you get an edition, it has Power and Market in it. In fact, this is from the Power and Market part of the book, where he goes beyond the modeling of the free market and talks about what happens when government taxes, for instance, right, which is no longer the free market. Yet economics helps us to analyze intervention in the economy, right? Forceful intervention in the economy. So this is from that section where he talks about the general sales tax and the laws of incidence. And it is excellent and not very long. So let's hit you with a little bit of theory. I bet you can handle it. So one of the oldest problems connected with taxation, Rothbard says, is who pays the tax? It would seem like the answer is clear cut, since the government knows on whom it levies a tax, right? So if we levy the tax on the business, then the business pays the tax. If we levy the tax on the consumer pays the tax. He says, but the problem is not who pays the tax immediately, but who pays it in the long run. That is, does the tax get shifted from the immediate taxpayer to somebody else? So this is the incidence of taxation. So here's where he starts laying it down. The first law of incidence is a rather radical one. No tax can be shifted forward. So no tax can be shifted from seller to buyer and on to the ultimate consumer. And he's going to talk specifically about sales taxes. That's the section we're going to cover. He talks about excise taxes also, but we're going to cover the sales tax bit. It is generally considered that any tax on production or sales increases the cost of production and therefore is passed on as an increase in price to the consumer. Okay, so this is what's the underlying theory here, right? It's that when we pay, we're basically covering the cost of the production of it, plus, some amount of profit or something to the retailer and the wholesaler and so forth. But basically what we pay is really tied to cost of production. And so they're saying that the naive view here is if there's a tax on production or a sales tax increase, that increases the cost of production and therefore it increases the cost to the consumer.
Yeah,
and I've throw in here.
I've heard this idea that the cost of production determines prices and things along those lines is labor theory by the back door, because essentially what that means is things get their value because of the things that went into them, one of which is labor and things along those lines.
Is labor. Right.
Yeah, it's how you get a lot of the orthodox economics in the modern day, and that ends up looking a lot like Marxism in how they deal with labor and other goods as well, that all are derived from labor. So Rothbard, in like the next sentence though, has a very radical suggestion for anyone that thinks along these lines.
Go ahead.
He specifically says, yes, prices, however, are never determined by costs of production, but rather the reverse is true. The price of a good is determined by its total stock in existence and the demand schedule for it on the market. So what we get there.
Right. Go ahead. Explain it.
So the selling price, what I sell a good to you for, is not determined by me because I have these costs that went into producing it, but rather it is determined by how much of it already exists and how much of it is wanted on the market, neither of which is the cost of production. So we have two different things going there. completely separate from what the orthodox idea is.
Right. So you've heard of supply and demand, and Rothbard is saying, okay, what's the demand? The demand is just, what people are willing to pay for the product. What is the supply? The supply is the, how does he put it? The total stock in existence. So there's the number of these
Right.
products that are out there for sale. So that's your supply and your demand. And
Yes.
then let's bring into the taxation bit now. And next thing he says is the demand schedule is not affected at all by the tax. So let's look at that demand side. How much consumers want the product, how much they're willing to pay for the product, is not affected by the tax.
Right.
Right.
And
I'm willing to pay $5 a pack for cigarettes, and whether 50% of that cost is tax, 90%, 10%, 0%, that doesn't change that I'm willing to pay $5 a pack for cigarettes.
Right.
Right.
You don't suddenly stop wanting things because you saw on the news the government is now taxing this item. Usually, you still want the good.
At a certain price, right?
Right. Yes.
Yeah. The idea is that it's just the naive notion here, I guess, is that people's demand is inflexible, and the government can just push the price up with these taxes, and people will just keep buying the same amount of the stuff. But that's not supply and demand. That says that you can change the price, and people won't change their behavior based on the price. But that makes no sense, right? I mean, that's not basic economics. Basic economics is that people are price sensitive as a general thing.
Right. Yeah. So that's the whole point.
Right. So okay. So think about it this way then. Now, the selling price is set by any firm at the maximum net revenue point, the most profitable point, profitable point. And any higher price, given the demand schedule, will simply decrease net revenue. Okay, let me translate out of precision speak here a little bit. What he's saying is that the seller finds, ideally, right? They find that sweet spot where I make my most profit selling at such and such a price. That's where people demand it, and I make money at it, and everything. If you go above that price, people just buy less of it, and you
Right.
get less revenue, less income from selling that product, and I think your profit goes down, right, above that point, above that sweet spot there.
Right.
So if that's the calculation they're making, the tax doesn't really change that selling price, right? It changes how much of that revenue is going to the government and how much is going to the producer, but it doesn't change what the best selling price is. The result of that is a tax cannot be passed on to the consumer.
Right. So, with that highest profit point, basically, if you go any lower, then more people might buy more of it, but you aren't getting as much per sale. And then if you go any higher, sure, you're getting more money per sale, but less people are buying. So you find that peak, and the tax does not change that because, as we just discussed, price isn't determined by the cost of production. It's determined by the total supply in existence, and it's determined by the demand for the product. So that point is your best selling point. A tax is just going to take out of your revenue.
Right. Okay. So skipping this next paragraph, Ryan, I want to go right to this. So a general sales tax is the classic example of a tax on producers that people believe can be shifted to the consumer. So the government imposes a 20% tax on all sales at retail, right? So a general sales tax. And he says, we'll even assume the tax can be equally well enforced in all places that people are purchasing it, right? So nobody's dodging it.
Right.
Let's just grant that for the sake of thinking through this. To most people, it seems obvious that the business will simply add 20% to their selling prices, and they'll serve as unpaid collection agencies for the government. So the pack of cigarettes was $5. They add a 20% tax. Now the seller charges $6 for the pack of cigarettes.
Right.
They still get the $5 they were getting before. $1 goes to the government, and consumers just face 20% higher prices for a pack of cigarettes. But here's the problem with that story, and that's the story that people are believing when they oppose this, when they say that, oh no, taxes get shifted to the consumer. He says, but here's the problem with that. There's no reason whatever to believe that prices can be raised at all. Prices are already at the point of maximum profit. The stock has not been decreased and demand schedules have not changed, right? So here's the biggest thing about economics that's hard. It's true of a lot of fields, actually. Not getting lost in the complexity and sticking to the basics, right?
Right. Yes.
Don't lose your fundamentals as people baffle you with all kinds of complicated bullshit. That's what makes economics hard, believe it or not. Holding on to sanity in an insane world. So what is sanity here? It's the supply and demand. Again, nothing's changed. The supply is the amount of packs of cigarettes in the world or whatever, right? The demand is people's willingness to purchase those prices at such and such a, or sorry, purchase cigarettes at certain prices. The imposing the tax changes neither side of that. You still got the same number of cigarettes in the world, and you've still got the same demand from consumers. They don't change their desire for cigarettes because of a sales tax on cigarettes, right?
Right.
So prices cannot be increased. Well, I mean, they could be increased, but it won't be profitable to increase them by the firm.
Right. You actively lose money by doing that.
Right. So no one's going to do that. Okay. So. Okay, yeah, I think he kind of beats that to death. Okay, so it should be quite evident that if businesses were able to pass tax increases along to the consumer in the form of higher prices, they would have raised these prices already without waiting for the spur of a tax increase. By the way, this is a move. I don't know that there's a name for this, but this is a move, Ryan, I see a lot in economic reasoning. Basically, well, why not? Why are you waiting? Just do it now,
Yeah.
or do it more, right? So this is an argument that you'll see, an effective argument, in my view, against the minimum wage. Oh, you can help poor people by raising the minimum wage to $15 an hour? Why are you being stingy?
Why stop there?
Yeah, why stop there? Let's all be millionaires, right? And let's
Right.
have everybody getting paid $3,000 an hour, right? And then
Right,
people
yeah.
go, oh, well, at that point, it might click for certain listeners. That's why you bother saying things like this. Certain people might click and go, wait a second, $3,000 an hour. No one's going to have a job. It's like, cha-ching, exactly. Right? Think it
Right.
through.
And what we see here basically is that I think that is the clearest refutation of this idea. If they could just raise the price and pass on the cost, then they would have. And
Right.
that
And instead of handing the increase off to the government, they pocket it. Hey,
Right,
profit,
yeah.
right?
and that really clearly demonstrates that this is not how it works. You don't
Right.
look at your costs of production and then determine what your prices are.
Or have an infinite ability to just raise prices, and consumers will just keep handing you ever increasing piles of cash, no matter how high you
Right.
raise the prices, right? It doesn't work that way. Okay, so he says, okay, next argument, because part of the argument is, right, well, the taxes are everywhere, right?
Hmm.
So that matters somehow. He says, okay, it might be objected that a sales tax increase is general, and therefore that all the firms together can shift the tax. Like the consumer has nowhere to run, right? He wants his cigarettes, and every seller, every gas station, in every state, all over the world, they all are going to increase the price of that pack of cigarettes by 20%. And he's got to have a cigarette, so he's just going to pay the higher price. He can't escape. He says,
Hmm.
but each firm follows the state of the demand curve for its own product, and none of these demand curves has changed. A tax increase does nothing to make higher prices more profitable. So the fact that it's happening everywhere doesn't change the situation, doesn't change the particular situation of each firm with each product facing the demand for that product. Because again,
Right.
the demand hasn't changed because there's a tax now. Okay.
Right. And supply hasn't changed either because taxes don't just eliminate things from existence immediately.
I'm sorry, say that one more time.
I was saying the demand hasn't changed, but neither has the supply. So, what we were
Right,
discussing
right,
earlier, they don't just disappear because legislation was passed.
right. Okay. Final point then. Here is why probably this feels counterintuitive for people and why we got some pushback last time. Many people are misled by the fact that the price the consumer pays must necessarily include the tax. When someone goes to a movie and sees prominently posted the information that the dollar admission covers a price of 85 cents, shows you how long ago he wrote this book. Dollar movie. Anyway, a dollar admission covers a price of 85 cents and a tax of 15 cents. He tends to conclude that the tax has simply been added on to the price. But $1 is the price. Like, what is the consumer actually paying? Are they paying 85 cents or are they paying $1? Walk through it really slowly in your mind. They're paying $1. So the price, from the point of view of the consumer demanding movie watching, is sorry, I'm distracted. Dave Bergeron says cigarettes are price regulated in most countries. Almost any other thing would be a better example. Sorry, I don't buy
Then,
cigarettes. I didn't know that. Okay, wait,
yeah,
let me
just say like
finish.
$5 of apples. Yeah.
Yeah, sorry. Okay, so what is the price from the point of view of the consumer, the one who's has the demand to watch the movie? From their point of view, it's $1. Like I said before, the fact that it's 85 cents to the theater and 15 cents to the government, 50 cents to the theater, 50 cents to the government, 10 cents to the theater, 90 cents to the government, it doesn't change it. The consumer is paying $1 for the movie back in the early 1960s when he wrote this, right? The consumer is paying $1 for the movie. And so the fact that it's shown to us as 85 cents goes to the theater, 15 cents goes to the government, it doesn't change the consumer's decision. I mean, I suppose it could in
Right.
the occasional case where the person goes, 15 cents to the government, I don't want a penny of my money going to the government. I'm walking away, right? But in general, people are just thinking about, I want to get this product. It costs this much. Do I want to pay this much for this product? Right?
Right.
Um,
So,
yeah.
yeah, he goes on to summarize that what the sale tax does do, however, is
Exactly.
eat away at any revenue that is generated by firms, and that's where the bad effects of the sales tax or any other tax that's supposed to be passed on. This is where the bad effect is, because whereas the previous argument was, oh, the consumers have to pay more, and that's obviously bad. The argument now becomes something much more insidious. The producers now have to pay more and can no longer use the money that they just earned in revenue to reinvest, expand, or make a higher quality product or whatnot because it's gone to the government. This directly impacts
Right.
the producer, and they are the producers in whatever situation you're in. You don't really want to hinder them. You want them to continue on with their entrepreneurship, continue on with their development, so that they can develop things of higher quality. So
Okay, and then what he says next is a little complicated. I'll just say that He says precisely the effect of a general sales tax. Its immediate impact lowers the gross revenue of firms by the amount of the tax. So it doesn't get passed on to the consumer. The theater just gets 85 cents instead of $1. Let's imagine that yesterday they had zero tax and today it gets too complicated. I was going to stop here. All right, Ryan?
Yeah, that sounds good. I think that we covered
Okay.
most of the pushback.
Right. So, yeah, main issue is just this incidence where he's saying it indeed falls on the seller or the producer and it does not get passed on to the consumer. Obviously, we suffer as consumers in a world with does have an impact.
Right.
It's just that we're not directly paying for it. Okay,
Right.
let's cover some other stuff. Ready?
Sounds good.
Okay, next, Ryan McMacken, editor of the articles on Mises.org, something like that. A lot of what you see on the front of Mises.org is going to go through Ryan McMacken, I think. But he also writes great articles, as I've highlighted. This one is, we haven't had Econ Minis for a while, so I parked this over 2 weeks ago. But we've been talking about the supply chain, and there's been a lot of talk about the supply chain. There's concerns. I think the president of the U.S. has been uttering the word supply chain, so it's in the air. Ryan is going to argue here that the Fed's inflation is behind the supply chain mess. I shared something on Twitter where Tucker Carlson is giving some very funny examples of people doing the, but what is it? There's the different stages, Ryan. It's not happening. Well, maybe it's happening a little. Okay, it's happening and it's good for you, right?
Yeah. And
so,
here's why it's a good thing. Yeah.
And here's why it's a good thing, right? So Tucker Carlson had some fun showing people saying, actually, here's why inflation is a good thing. We consume too much anyway, or, whatever.
Yeah.
So
it's better for the environment.
But as one friend pointed out, it didn't show that he necessarily understood how inflation's coming about because he blamed it on high spending bills, large spending bills coming through the Congress right now and stuff like that. And that's Austrian economists know that inflation is related to the money supply.
Yes, it is a monetary phenomenon. That's it.
Exactly. No matter how many times Lord Keynes too says otherwise on Twitter. Okay, so what does he say here? I think this is a little bit, like I said, we're a little bit behind on this story because now I think they're not explaining away supply chain shortages. They're trying to address them, and the administration's addressing them in other ways. But 2 weeks ago, he said, it seems supporters of the Biden administration finally settled on a narrative they like for explaining away supply chain shortages. And here's their talking point. The U.S. economy is rolling along so well that Americans are demanding huge amounts of goods. That's overwhelming the supply chain and causing the backups roiling America's ports and logistic infrastructure. So the argument is, and once again, like the last thing we talked about, Ryan McMacken is going to explain that they're kind of right, maybe for the wrong reasons, but they're not totally wrong, right? Okay. So their claim is economy's doing great, Americans demanding huge amounts of goods, and the supply chain just can't keep up. So we got such an awesome recovery going on, economic recovery, that it's resulting in high demand, and the high demand is overwhelming the supply chains. Okay, so I'm going to skip various Jen Psaki and so forth saying this. He says Ted Cruz mocked this, and they point to other reasons why the supply chain's having a problem, like government regulations, COVID lockdowns, affecting productivity of supply chain workers, so on and so forth. Yet, he says, the administrator's defenders are right about consumer demand and spending, even if for the wrong reasons. But we'll start with how they're right. Positive people, these Austrians, right?
Yeah.
We'll grant you exactly where you're right, and then explain why you're wrong. Really, Okay, so he says the global volume of trade and shipping volume in 2021 have actually exceeded pre-pandemic numbers.
Yeah.
So there is indeed a high volume of trade and shipping going on. Okay, so that seems to fit in with that story. High demand, high impact on the supply chain. A lot of things trying to pull through the supply chain. Um, he says it's not as if little is moving through these ports. More is moving through them than ever before. That suggests demand is indeed higher. So he says so far, the second part of the story, demand leads to overwhelmed supply chain. He's saying that seems plausible from what we can see, facts on the ground. Here's the problem. Why is it higher? Their explanation is that the economy is doing great and people have money because, so many people are working and making money and so forth. He said, right. He says, in some ways it is true that, as Jen Psaki says, quote, people have more money. But then we run into a problem. The question is, why do they have more money? And Ryan says it's because of monetary inflation. Joe Biden hasn't successfully guided the economy through anything, but it is accurate to say that people have more money in a nominal sense. Wages are up nominally. There's more paper dollars running around, and it's resulting in higher wages, right? This also means a lot more pressure on the logistical infrastructure as people buy up more consumer goods. So there's more dollars chasing more goods, okay? More consumer goods. The idea that supply chain problems are driving inflation gets the causation backwards. It's money supply inflation that's causing much of the supply chain's problems, not the other way around. So you rain money down on everybody, they go out and buy stuff, and your supply chain gets overwhelmed.
Yep.
Okay? That's not the same as a healthy, growing economy. The economy is growing, and as a result, people have more disposable income.
Yeah, that would require actual saving, and our modern policies kind of prevent that.
Well, now wait a second. That is what he covers next, and that's an interesting story here, because we did see savings increase for a little while. Okay.
Yeah. Okay. There we
okay.
go.
Okay, now let's see. Why do I want to talk about this? Let's see. Oh, well, first of all, Academic Agent has been saying, primarily correctly, that through a lot of these times, when people say, hey, the Fed increased the money supply and all these things you guys predict didn't happen. And Academic Agent typically responds and says they kept it in the banks. They didn't loan it out. It just sat there in the big banks. Ryan agrees mostly. He says some of the increase, like he points to a 35% increase in a year and a half in M2, which is just insane. Some of it has kept within the banking system through the Fed's payment of interest on reserves. But a lot of it clearly has entered the real economy through stimulus payments, unemployment insurance, federal deficit spending, right? So it's not like there's no spending going on. Yes, the banks are holding on to a lot of it. If they didn't, then we would probably see hyperinflation with those kind of money supply increases. But some of it is definitely leaking out in these various ways. Direct checks to people from the government, for example, the stimulus payments. Now, what happened at first is the public was saving a lot of the stimulus and the bailout money, and the personal savings rate hit a historic high of over 25%. That's amazing. I'm expecting, when he says at first, he started this period with like February 2020, right? So the pandemic, the lockdowns, people are like, we don't know what's coming. We're gonna save any extra income we've got and make sure we're ready to, pay high prices for toilet paper or whatever, right? That's a year and a half ago.
Right. Yes.
But he says this past summer 2021 now, so that's almost a year after all that stuff started last year. This past summer, the savings rate collapsed again. And as of September, it's back under 8%. So yes, there was savings for a while, but then people were like, maybe our world isn't collapsing. and they went back to spending again. Okay? So he says the public is now flooding the economy with its former savings. So there was an extraordinary amount of saving in 2020 because of concerns, 2020, maybe early 2021. And then in the summer of 2021, people relaxed and started spending some of that money they'd saved. Go ahead. Right.
Well, I was just going to say, it's a bit of a perversion of what you would expect in a normal, unregulated system, in regards to savings and spending. Because typically you wouldn't expect people to just, due to, government shutdowns, media scare tactics, and all that, to suddenly start saving a ton, and then when something arrives, to just suddenly spend it all. Correct me if I'm wrong, but usually you would expect people to save and then invest some of that while spending some of that, would you not?
Right.
You don't usually just have people that just go out and spend everything.
Right, and Ryan doesn't completely spell that out, but the implication seems to be that people saved because of uncertainty, which that makes total sense last year, right? Things did seem very uncertain. Yeah, I'm sorry. I only mentioned the pandemic and the lockdowns. 2020 was also some cities being burned down and stuff, right?
Right.
So for a number of reasons, people were feeling uncertainty last year. And when people feel uncertainty, they want to have higher cash reserves, right? Just in case they need it. But what he's suggesting here is they didn't then take those cash reserves and start investing with them or something. They just, the uncertainty dribbled down, got down to a lower, okay, looks like the world is not going to burn down and explode in my face. It's not going to be a post-apocalyptic nightmare. And so I'm going to take those savings and just go back to spending again. In fact, now I've got a chunk of money to spend because of what I was saving because of uncertainty, right? Yeah.
Right, and now we're back onto the original timeline.
Yeah, and now we're back to just people not being very good savers, which is where Americans have been, and a lot of, not just Americans, I think, if I remember correctly.
The West, yeah.
The West, yeah. Okay, so he says, here's a problem with the triumphal story of the Biden administration, which is that, economy's going great, and that's why people have money to spend. He says, today's tsunami of spending raises questions when we consider there are still about 5 million people working in the American economy than was the case in early 2020. So you'd think that a recovering economy would mean people would be back to work. But Ryan says, no, they're not back to work. We're still 5 million jobs down, and yet a lot of spending is going on. He says, without monetary inflation, an economy with millions of fewer workers suggests there should be less spending, right? 5 million people thrown out of work since early 2020. Even with recovery, if those 5 million, we've got a bunch of people that haven't been able to get back to work, we're going to have less spending. I mean, 5 million people without jobs is a lot less money to spend. But the government's been injecting all this money, right? Through inflation.
Yeah. That's assuming the government won't just print everything they need. That's assuming that they spend tax money and not whatever they can, plus the money printer.
Right. Okay, now there's one other factor to consider, which is that when the public suspects that inflation is going to increase, they increase their spending. Now that might seem a little confusing at first, but think about it. You got to think about the value of money. Think in terms of the value of money. If money is more valuable, like let's say I buy Bitcoin, right? Bitcoin, I think Bitcoin's going up. I want more Bitcoin. If I think the value of Bitcoin is going down, I might get rid of some of my Bitcoin, right? I might let go of it. What money inflation means is that the value of money is declining. So if the value of money is declining, I want less money, and I'd rather have goods or services or something useful to me rather than holding on to cash that is declining in value. So von Mises said, once public opinion is convinced, the prices of all commodities and services will not cease to rise. Everybody becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. And ultimately, in a hyperinflation, Mises talks about the flight into real goods, meaning people are doing anything they can to get out of cash and hold on to something that might still have value tomorrow, because the cash certainly won't during a hyperinflationary thing. Yeah.
Usually, literally anything else.
Yeah, anything. Yeah. I mean, obviously, it'd be great if it could be gold, but people will just be like, anything I can have that might be valuable tomorrow, whereas the money's going to be worth half what it, tomorrow it's going to be worth half what it is today, or, in a really bad hyperinflation, that sort of thing happens. So that, again, means more spending. So money inflation, handing out a lot of money, consumers perceiving that money is becoming less valuable. They want to get that money out of their pocket, because keep leaving it in their pocket is not a smart move, right? Okay. Let's see, skipping forward just a bit. Ordinary savers are surely now remembering that the interest returns from savings right now are next to nothing. This is just to emphasize that, as Ryan Turnipseed pointed out, we don't think that those savings ended up going into investments, right? People just went, they held them in cash for a while against uncertainty, and then they just started spending them on consumer goods. Well, why not? Well, one reason is that interest rates for consumers are terrible. If you open a savings account, you get like 0.1% on your money. That's not much motivation to stick money into a savings account, right?
Yes, and it does something else, and I've been doing a lot of research into 2008 and all that, so that's kind of where my mind has been for the last week.
Okay.
If you've meddled with the interest rate and you've really lowered it much lower than what it should be, unless I get this backwards, and I hope I don't, it's signaling that there's a lot more savings than there actually are.
Right.
Because then you can get loans for much cheaper. The interest rate is really low, and it's signaling to people that they have saved up, and now their money can just be loaned out at a much lower cost, at a much lower interest rate. So not only does it discourage saving, but it also encourages taking loans and spending that money, even though the savings aren't there to back up the loans. And if that sounds familiar to something that might have happened in 2008, it's because it's happening now, but on a total scale.
Right. Okay, so he says regular people are stuck with interest rates that don't keep up with price inflation, so it makes more sense to spend dollars rather than save them. That's an important point. Not only is the yield on your savings or investment very low, but you've got price inflation to compare it to, right? The whole idea of a good savings or investment is that it's going to increase in value faster than money inflation. It's a hedge against money inflation. But if sticking it in a savings rate is going to lose money, right? It's gonna become it's gonna lose value faster sitting there in the savings account. I'm sorry, I'm getting myself mixed up. Anyway, it ends up not paying. It makes more sense to spend dollars rather than save them.
That becomes your investment at that point, not because it's like a good investment, but because it's better than the terrible alternative of just sitting on it.
And then just jumping to the end, he says, at least as far as the third quarter of 2021 is concerned, it's fairly clear the U.S. was, and likely still is, in the midst of an inflationary boom. Hold that thought for later when we get to the bubble stuff. Okay, let's see. Let me think here. I'm going to skip this George Selgin one, and let's just wrap it up with these three. Okay, so not able to put a full story together here, I don't think, on how this shortage is related to everything else going on, but just wanted to point it out because a number of people seem to think that this could be something that has an impact on us in a very direct way. So the issue is that there's shortage of nitrogen fertilizer. Okay, now why does that matter? It matters because nitrogen fertilizer is key to agriculture. Okay,
Right.
and if you don't have enough nitrogen fertilizer, we have trouble growing food.
Right. The entire agricultural system, since we've been able to make nitrogen fertilizer, which would have been basically the time period between like 1930 and 1970 or so, the introduction of really cheap and mass-produced nitrogen fertilizer has meant that our agricultural system has reshaped itself around the fact that we can have that. And that's what farms rely on now. That's what a lot of your food production relies on now. It is really vital. So a shortage of this is a pretty big alarm bell.
Right. Yeah, but we'll track back a little bit of what's going on here, but what are the potential impact? Well, the impact is on food production. So, right? One of the things they mentioned, a couple of things they mentioned specifically, it says prices of nitrogen fertilizer, one of the most commonly used fertilizers to boost production of corn, canola, and other crops. They're at their highest levels in more than a decade. Okay, so possible clue here, hearkening back to when we had Dark Horse on the show, and we were looking at the natural gas market and transportation of natural gas. Natural gas, it turns out, is a key input into the production of nitrogen-based fertilizers. And so the shortage of nitrogen-based fertilizers relates to higher costs of natural gas, one of the inputs into this, and that's caused some producers to cut production. They can't make the nitrogen-based fertilizer profitably, and so they just made less of it because of the high natural gas prices. I don't know if there's anything else I wanted to call out here. Just some strange stuff going on in this market, and just wanted to briefly touch on it for us to keep an eye on it. Okay, so it said US based CF. What is CF? I don't know what this company is.
Hold on,
CF
give me a
Industries.
moment because
Anyway,
that sounds
CF
really
Industries.
familiar.
I don't know that it stands for anything, or well, I'm sure it stands for something, but it seems to go by the name CF Industries. It says US based CF's predictions of constrained crop production. Go ahead.
They are your nitrogen producer, your nitrogen fertilizer producers.
Okay. It says they warned rising fertilizer costs would drive up food prices and could lead to famine. That's part of the reason I brought this up. Famine, seems like a strange word to say these days, but it got my attention a little bit there. And then it mentions that the Prime Minister of Russia said it's going to limit exports of nitrogen fertilizers for 6 months to try to keep the food prices from increasing in Russia. China is also limiting nitrogen exports. So, yeah, things are going on in the fertilizer market, and that affects our food prices. Food availability.
Probably something to keep track of in the short term, or medium term, rather.
Yep. Right. Well, in the northern hemisphere, the growing season is over, so I don't know when it's gonna. Well, I don't know. It's a global market, so it's maybe affecting the growing season in the southern hemisphere, right?
Right. Yes. And if I remember correctly, I think there are things that nitrogen fertilizer is used for in certain places in the northern hemisphere after spring, summer, fall. Though I could be wrong on the scale.
Okay. Now let's turn finally to just a couple little indicators of us being in a bubble. I'm wondering if we can come up with more for future shows, but got to start somewhere. First of all, we have an article about fintech. I'll explain what fintech is in a moment. But a billionaire investor named J. Christopher Flowers said that quote, I think there are a lot of indicators that there's a bubble in fintech. Okay, so what is fintech? Fintech is like PayPal and Square. Fintech is financial technology. So these are firms that are dealing with payments, for example, and applying technology to that area of payments, right? So PayPal,
Right.
Square, Venmo would be another one. Many other players in that industry, right? And a pretty interesting sector for sure. Nevertheless, he's got some concerns. So, comparisons are helpful sometimes. He says PayPal, for example, has a market cap of 242 billion, which is higher than that of the Wells Fargo Bank, Citigroup, or Citigroup. Okay. So he's thinking that's a little crazy that, this sort of middleman financial tech firm would have a higher market cap than some of the biggest banks operating in the US at least.
Right.
And furthermore, he compares Square, which is, by the way, Jack Dorsey from Twitter. It's a company of his, based in St. Louis, I think, by the way. Square is worth nearly $107 billion more than US Bancorp. So he's going, this is not smelling right. He mentions among privately held companies, so those are both public, PayPal and Square. Among privately held companies, Stripe was last valued at an eye-watering $95 billion. So really high valuations on these fintech companies. He says many companies in this sector, in the fintech sector, trade at 10 times what a normal company would trade at for that kind of thing. If you look at their metrics to try to kind of compare apples and apples as much as you can, he says the valuation of these companies is off the charts, order of magnitude out of line. So that makes it seem like this is kind of hot, kind of a bubbly area of the economy. Let's see. Right. And he says investors have flocked to high growth companies at a time when interest rates are at historic lows and money is cheap. And fintechs have benefited from a surge in demand for online services with the lockdowns, right?
Right.
Okay, so little sign to watch for there. Interesting. And then this story is particularly crazy, our final story here. And then let me just tell my wife that we're going to wrap it up quick and I'm going to take them to karate.
An actual mini episode.
Yeah, I had been thinking we ought to do it. Okay, so this is Jim Cramer. I don't know how much I want to endorse Jim Cramer, but there are some interesting points in here on this. He talks about two companies, Lucid and Rivian. These are electric vehicle companies. Okay, so think like Tesla, just not as famous as Tesla, right? And he says he compares these high-flying electric vehicle stocks to the dot-com bubble. And his basic advice is, okay, you can make some money just like you could during the dot-com bubble if you make sure to get out at the right time. Don't write it down if the bubble bursts, So he's basically saying you're taking your chances in this market. You can make money, but you could lose money too. And he says, people are trying to find the next Tesla. I get it. But you have to get in and out. Okay, anyway, so that's the context. He's talking about investment tips or whatever. So Rivian and Lucid. It is, let's see. Here's the one here's what's fascinating about Rivian. It has next to no revenue. This is the one I mentioned in the marketing for this show that had 156 products, 156 electric trucks they've sold, mostly to family and friends of the company, believe it or not. their market cap of 124 billion is larger than those of General Motors and Ford. Okay, so this really caught my attention because this is the kind of thing we saw like with the dot-com bubble.
Right.
Here, go ahead, say something. I need to say something myself.
I was going to say that when you see a company that is really highly valued but has really low revenue,
Right.
but is nevertheless growing and really highly valued, that usually signals that there's probably going to be a correction somewhere along the way. Because like if we can see it here, other people will be able to see it as well. Like we aren't the only ones with this knowledge.
Right. Exactly. And it was really interesting the comment that, you know, people, the low interest rates, people are looking for somewhere to park their money. And this is what
Right.
this is one of the things that happens in a bubble is people are looking for growth for their money. And in a bubble, they end up, in some cases, putting it in some pretty highly speculative places, right?
Right.
Okay, so that's that one. And then, oops, back to the article. Yeah, Lucid delivered it late last month, delivered its first vehicles to customers. Okay. They've recorded less than $1 million in revenue over the first 9 months of 2021. They have a market cap of $85 billion. So let's just look at that for a moment. $1 million in revenue for the year. So the year, so calendar year so far. Market cap of $85 billion. Okay. So what? Okay. So anyway, I want to wrap it up early to get my kids to karate. Let's look at tips and super chats real quick, and then we're gonna have a mini Econ minis for once. Okay. Oh, this is from a week ago. It must have happened right after the show. But Sam153 sent money and said Happy Thanksgiving, and he did it twice. I don't know if he meant to do that, but anyway, maybe it was Happy Thanksgiving to each of us. I don't know. So thank you, Sam153. And then we have one from Jedi Knight Anakin Cringewalker. Anyone who's been around academic agent circles knows that Jedi Knight Anakin Cringewalker single-handedly supports our entire network of YouTube channels. Just about. Anyway, he says, historically, doesn't chaotic decline like this put a massive pressure on micromanaging yourself into a failed state? I'm not sure I completely get what he's trying to say there. Doesn't chaotic decline... Do you get it?
I think the gist of what he might be saying is chaotic decline will scare people that are supposed to be doing things normally, and then they end up panicking and taking a bunch of intensive measures, which in turn cause damage or are bad decisions, things like that. We've seen this all over the place. The Weimar Republic just inherited a country that lost a world war, so they quite knee-jerkily printed a ton of money and just doomed themselves into hyperinflation. And you can see our country is kind of doing that. They just have a more sophisticated method to where the effects of doing so won't be felt for a long time, but they still have done it. So unless he meant something completely different, I think that might have been the sentiment behind it.
Yeah, and I don't know why, but I feel like I've noticed that he rarely follows up in regular chat with clarifying his super chat or anything like that. Because sometimes I'll wonder and I'll look and he just never does. I don't know why that is.
He might watch later.
He only wants to communicate via super chat, which, hey, works out for us. Right? Anyway, thanks for your support, everybody. And we're going to keep this one short this week for once. And we have, as usual, I don't feel like in Econ Minis, we have to be comprehensive and cover everything. We're following certain threads, keeping an eye on certain things. And in this case, I just wanted to open that topic of, are we in a bubble? Let's start watching for the signs. Please do send me articles that you see that make you go, that valuation seems astronomical, say.
Yeah, and every bit of economic theory that we have suggests that we should be in a bubble that encompasses just about every industry by this point, looking at interest rates, spending, everything that's happened.
All right. Okay. Thanks, Ryan. I think these wonderful credits are gonna smoothly scroll once again. I'm excited. Here we go. Bye, everybody.